Hello, advanced financial planning students. This is now week two. For week two, looking out here in the course, you're going to have a brief forum discussion. I'm going to put out there a question relative to what you use for cash flow. Some people use Quicken, MSN Money. I just use Excel spreadsheets, but I'm kind of curious to get feedback from you, because if you were to work with a client, one of the things you really want them to do is make sure that you are tracking a balance sheet, personal cash flow statement, look at discrepancies, and also anticipate where there might be needs for cash flow in the future or surpluses of cash flow in the future. So it's a really good planning tool. And I've also put out there under the main documents too, kind of a checklist, if you will, of all the documents a certified financial planner would probably request when they would meet with someone to do a financial analysis. So you'd probably want previous year's tax forms, and you probably have to ask the client question too about how do they spend their money. Some of them may already have cash flow statements, some software or spreadsheets that they keep track. Some may be less organized. You might have to guide them to kind of create that, or work with them to use software or a spreadsheet to kind of show them that, hey, this is your situation. So, well, looking at this week's chapters, the first one, the chapter 4, in the theory kind of says that, maybe we should really treat the household almost like a business. In fact, in these cash flow statements down the road, as the author suggests, is not just do a traditional cash flow statement, kind of almost do a cash flow statement like we see in the business world, cash flow from operations, cash flows from financing, cash flows from investing. So it kind of gives a bigger picture or better picture of kind of what's going on with the cash. But, it's a way of looking at this different. They talk about the life cycle theory too, that, as we start working early in life, start progressing, our income starts increasing, and then we start building up net worth. But at some point, if one of our goals hopefully would be that we want to retire someday, we're probably actually going to start eroding away some of that net worth. And it's do I want to leave some for my children or grandchildren? Those are questions you have to ask when working with the client. Chapter 5, I'm going to get to that. That goes over financial statement analysis. Again, you probably looked at this from a business perspective in a finance class, but now we're looking at much more detail from an individual's perspective. And also, they mentioned the pro forma statements. Something that I probably even need to do is, I should really be looking almost 30 years out. We could all do that. Project our income out. We'd expect increases, some increases in inflation. There's going to be increases in expenses too. But, at what point does the actual maybe mortgage payment stop, and all of a sudden you get this big inflow of cash, and what would I do with it at that point? What would be a wise decision? Maybe after the last mortgage payment you have a big party, but what's a really good decision to do once we reach that point? Or do we want to make changes to try to accelerate the payment principal on a mortgage? Or maybe that's not a good idea, especially if your interest rate is so low. Would we have been better off putting that money into a retirement account, because the return and tax advantage that we've got on the retirement account would increase our net worth so much more? And that's really where these tools like you did previous week of calculating time value money calculations are so important, because you have to look at those what ifs. Would you actually be better off in net worth by paying off your mortgage early, or would it behoove you to not do that? Especially today, many people have low interest rates. I know I have an interest rate at 3%, and with the after-tax, after-interest rate, it really behooves me not to really pay off my mortgage right away, unless it's just a cash flow concern for me. But the better goal for improving my net worth would be actually to put more towards the retirement as much as I can, and just slowly pay off the mortgage over a period of time. And that goes back to that concept of opportunity cost. We continue in chapter 6 with a little bit more of the cash flow planning and budgeting. Budgeting is important because it's also a way that you'd want to show a client that say, hey, here's what you said you were going to do, but this is what really happened. And where do we need to be a little bit more stringent, maybe of, maybe not eating out every night, or if this is really how you're going to approach your goal, your financial goal to get there, maybe we're going to have to make some adjustments. And it's kind of reality check too. And then in the last chapter 7, it talks about financial leverage, and obviously debt is a concern for everyone. To me, it's more about how we use that debt. If you're using that debt to buy a house, use it for a car that you're going to need to travel back and forth to your job, or as you all are in education, that's probably a good form of debt. But if I'm using that debt to spend a lot of time in WWE SmackDown and WWE SmackDown belts, and probably not a good investment. We're not going to get a good return on that. So it doesn't mean that we can't have fun in life, but just we're trying to manage our cash. What are good decisions, again, that's going to try to reach our financial goals and to improve our net worth situation? And the textbook also mentions there are different, liquidity ratios and ratios we'd want to look at when measuring how much we'd want to take out in debt for a house, what's realistic for us. So I'm not a big fan of saying that zero debt is the ideal financial goal, especially when there are tax advantages at times. But how we manage that debt and avoiding, especially what I would say, that discretionary income. If you're using a lot of debt for discretionary income to eat out all the time, that's probably not a good use of debt. And we're spending a lot of money on credit cards, on excessive travel and vacations, and buying new clothes that you don't maybe necessarily need. That's probably not a good decision if it's not going to help you meet your long-term financial goals. Okay. Well, again, do send me an email if you have any questions. I've been really pleased so far on the discussion post and how the course is progressing. And otherwise, have a great week, and we'll talk to you soon.